Dan Geltrude joining us, Rob Luna with us as well, both expert reads on these markets. Dan Geltrude, to you on the quarter point hike we think we see coming from Jerome Powell. I think he's all but announced it. What do you think of that? Is it enough?
It's right now is inflation not only is here to stay for a while, it's going to keep increasing. When we're looking at the price of at the pump, for example, it's up 7 cents just today, again, with no sign that it won't continue to rise. Everything in this country going from point A to point B is going to be using fuel. That means prices are going to continue to go up. A quarter point from the Fed is going to do exactly nothing. Jerome Powell, now that he's been reappointed and he doesn't have to tiptoe around that issue, really needs to get a little bit gutsy here and at least go half a point and probably continue to raise from there.
You know, the flip side of that argument, Rob, and I've heard Dan's argument, it's quite the consensus one here. You got to be aggressive. But in this situation here, do you want to bring on the stag part of stagflation? In other words, we have an underlying strong economy, aggressive rate hikes, they'll warrant it.
Yeah, no, I completely agree with you. I think Dan brings up some really good points, Neil, but there's a lot of things going on. If you look at real wage growth, really actually since the stimulus ended, Charles Payne pointed this out recently, it's not really growing. And then you add inflation, the consumer is being strapped right now, Neil. So I think the Fed, they're way behind the curve. The question now, is it too little too late? You actually see the 10-year starting to pull back. Fed funds futures really thought we were going 75 to 100. I think it's 25. I do think 50 is the right move, though, here, Neil, because the market's already priced that in. I think anything less than that, it's going to be too little at this point.
I just wonder, gentlemen, and Dan, I'll begin with you, if we're going to see a sort of two different worlds on rates. For example, shorter-term rates kind of being where they are, longer-term rates backing up a little bit. I wonder all of this happens on the same day we get word that 30-year mortgages are back under 3.9%, I believe 3.87% for a 30-year fixed rate. I only mention that because some of the backup of that and the concern about what's going on in Ukraine prompted a flight to quality, if you will, that was driving down interest rates to the point where people who might be looking for a home have a chance to see favorable rates or refinance the home they're already in. I don't know whether that will happen, Dan, but how do you play this?
Neil, when you have low mortgage rates, people automatically think, well, this is a great opportunity in the real estate market. It might be, but it's not guaranteed, because when you have those rates coming down for mortgages, what happens is that the price of real estate goes up, because all of real estate purchases are driven by the monthly cost and the price of the property, and the mortgage rate is kind of what brings that imbalance. So as long as mortgage rates stay low, the price of real estate is going to stay high. And to me, that is the most dangerous time to buy real estate. It is better to have higher rates and lower pricing.
But then again, you're pretty cheap, right, Dan? I mean, you're not kidding. Rob, let me offer one of the bullish arguments here, and this is sort of like a big macro view, that with everything that's been going on, we've seen that the U.S. remains a haven. Our bonds, any dollar-denominated assets, our real estate, that's gotten to be very popular, certainly even among some former oligarchs. That will continue after Ukraine, no matter how it ends, because there's a new world financial order where the U.S., which for a while was getting to be like a Rodney Dangerfield of the financial, not getting the respect it deserved. But now, and this is nothing to do with politics, this crisis reminds us, as has happened in many crises, that the U.S. remains a draw and will continue being more of one in the months, even the years ahead. Do you buy that?
Of course I buy that. I mean, we are that shining beacon, Neil. I mean, you look at what's going on around the world right now, whether it's China, Russia, everybody is trying to get their money out of the country and into here. And let's keep in mind, the Fed can only control short-term interest rates. So as you alluded to, that demand that's coming in here, even if the Fed wants that to happen, they run the risk of inverting the yield curve. And we all know that gives us a higher probability making. Look, the real estate market, there's a lot of new entrants in here also, let's remember, Dan. You know, we've got Blackstone, KKR. You look at places like Phoenix, they are bidding for single-family residents against some of the home buyers out there. You have a huge amount of new buyers, a lack of supply, low interest rates. I think, personally, the real estate market continues to go up, and I think once this is all said and done, you're going to see a massive rally in the stock market, especially some of those areas who've gotten hit like technology.
Interesting. Our final word on that, Rob, I want to thank you. Dan, thank you. And the joke is on Dan here. He's actually one of the most generous people I know. He just doesn't like it when the government starts spending your money like crazy. But gentlemen, thank you both very, very much. It's interesting, Dan, when you think about it, that our exposure certainly to Russia, not like it is with China, but I wonder if it's giving China pause about any more provocative actions with regard to Taiwan or these military exercises in the South China Sea, that, they might be sort of reading the room, so to speak, and that in a weird way, and I know this is just my twisted thinking, it could prompt them to behave a little more. You know what I mean? Not that we're a direct threat here, but they see what's going on, the world condemnation, the economic, retaliation that, I think Rob was sort of spelling out, that's minimal by comparison, and thinking,
Well, let's hope they're thinking that way, Neil, because certainly nobody wants to see military conflict, and I don't really believe that China wants that. China is clearly looking for world dominance, but they're on a path of economic world dominance. So anything that's going to interfere with that, is, quite frankly, not good for business. So I do think that they're monitoring things very, very carefully, and they certainly don't want to disrupt their economic path. However, if China really feels the need that they need to take over a country like Taiwan, they'll do it, and they're going to look to see what the model was related to Russia and what the fallout is going to be. And then they'll have an understanding of what they're up against.
Gentlemen, I want to thank you.